Hi, I'm Linda Eedes, and I'm here today with Wim Murray, who is one of the portfolio managers on the Foord Equity Fund. And first of all, I'd just like to congratulate you on the excellent performance of the fund over the last year, pretty much since the time that you started managing a portion of the fund, I noticed. I wonder if that's a coincidence. I'm sure it isn't. But we're going to be talking today about some of the opportunities in the local equity market. Wim, we can broadly divide that market into three categories, which is, of course, your global companies, which are listed in South Africa, but have revenues coming from around the world. And there, obviously, I'm talking about the Anheuser-Busch's, the Richemont, the Naspers. And then, of course, we've got sort of more domestically focused businesses, which we always sort of like to call the SA Inc. businesses, very much tied to the local economic cycle, which, as we know, is going through a bit of a tough time. And then resources we sort of put in a separate bucket, because although they are rand hedges, they are obviously tied to the commodity cycle, which is obviously quite separate. So first of all, looking at those three categories, which do you think at this point in time offers the most attractive opportunities?
We're fairly lucky at the moment in that two of the three buckets look fairly attractive to us. So SA Inc. is reflecting a lot of bad news and a real dire outcome. But as long as that's being incorporated into the share price and adequately being rewarded for the risk, and you overlay that with stock picking where you're able to pick the best companies that will still do well even in a tough environment, then there's a lot of value to be had within the South African context. And then on a global basis, we're finding some of the Anheuser-Busch and the British American Tobacco and even the Naspers also still offer value. So you're able to have a fairly diversified portfolio, both on a geographic and on a sector-specific basis, that you can construct a portfolio that we believe will continue to do well. The only one of the buckets that we remain concerned about and where we've been cautious for quite some time would be on resources. There we continue to think that going into a recessionary environment, it will be a tough time for them. And at the moment, they are trading on peak margins and peak returns on capital, which for these cyclical businesses is a very precarious position to be in. So if we do go into an economic slowdown, we think there could be significant operational leverage to the downside, and we could see the earnings coming off quite significantly. So we've been overweight for some time, and we continue to be.
And Wim, talking about those South Africa incorporated stocks, now you spoke about the fact that the prices are low, very attractive valuations. How does one actually differentiate between those businesses that are going to really come under pressure as a result of the economic environment, and maybe those low prices are justified, and those where, you know, the baby's been chucked out with the bathwater, or perhaps even might benefit from the environment we're in? I mean, how do we separate the value traps from the value opportunities in that space?
We've always had a bias towards higher quality companies and also companies with good management. Now, that allows you to both handle all the challenges you are faced better, and for good management teams, they are able to find solutions and position the company accordingly for the times we are going in. And then we are seeing businesses that are able to gain market share even in a tough environment. So if we were to see GDP growth being very pedestrian, there are still areas where you can actually grow earnings, or where we believe the earnings base is sustainable. And if the multiple is low enough, you need very little earnings growth to actually justify holding the share. You just need to be very certain that the earnings being incurred today will continue into the future. So that would probably be the biggest factors we continue to focus on.
And I mean, I suppose the holy grail are businesses that have decoupled from the economic cycle. I mean, are such businesses to be found in South Africa, or is that too big a hurdle?
So when we look at market share gains, or for instance, Aspen, which has been a big holding for us for some time, they're very low beta stocks. So when we talk vaccines, that will continue to happen whether there's economic growth or not, or for the pharmaceutical spend, we'll continue to see an aging population and the demand will continue to remain. And then there's certain perhaps slightly lower quality companies like Wilson Bailey, where we believe the order book that they've already seen in the past while. If that flow continues to flow through, then they'll do well regardless of the economic growth that should flow.
And I just wanted, you mentioned Aspen, and I just wanted to touch on that because, Aspen and Naspers are two of the stocks that are contributing hugely to our returns, have done exceptionally well. But a year ago, you would have been defending those positions. I mean, how do you actually sort of look through short-term negative impacts to the firm? How do you differentiate between, a business that's valuation has been sort of permanently impaired versus one that's going through a tough time where actually the lower price is an opportunity?
Yeah, so that's where it comes back to fundamental analysis, and we spend a lot of time thinking through the various assumptions that underlay an investment case. And you need to be very sure, and you need to be open-minded to updating your views as new data points flow. So in the instance of both of those, we just go back to our valuation on Tencent, and we believe there continues to be some upside to the underlying price. And then there's still some further unlock to the discount that we expect to happen going forward. So at the moment, if you trade at around a 40% discount to the underlying holdings, and then you overlay on that a buyback program, it becomes very attractive. And we continue to think on a 3 to 5 year basis, there's more value to be had.
Okay, great. And then, of course, looking at some of the other positions, a business like Anheuser-Busch is sort of arguably at peak earnings. How does one justify whether you should continue to hold it? I mean, in terms of the forward-looking growth prospects from this point.
So it's interesting. They are at peak volumes at the moment. But in terms of earnings, we've seen such a inflation push on the cost side that they've actually had their GP margins squeezed. So the profitability per litre of beer sold is actually lower today than it was, say, 5 years ago. As we know, they had quite a bit of gearing that sits on the balance sheet as well. So the impact on the bottom line profitability has been fairly pronounced over the past number of years. But what we expect to happen going forward is for companies that have fixed rates of debt, and in an inflationary environment, you are actually in a very good position to de-gear your balance sheet as you pass on the inflation to the customer, which up until now they've proven to be able to do. So we expect for there to be some financial de-gearing going into the next 3 years. And then we think the margins being earned per litre of beer is actually fairly low at the moment. So it should be flat to going slightly up over the medium term. What we are watching fairly closely at the moment is just the multiple the stock is trading at. So it's re-rated fairly strongly over the past year, and I think year to date it's up close to 20%. So in position sizing, we'll take that into account. But we actually think there's some earnings upside surprises that could very well flow through over the next while.
So it's a case of obviously focusing on the income statement, sort of the earnings prospects going forwards, but also not neglecting having a very careful look at the balance sheet, so especially in a rising interest rate environment, getting to the peak probably, but still something to be aware of. And then, of course, the last piece of the puzzle is the price you pay for those underlying fundamentals. Yeah. But thank you very much, Wim. And now if you could just keep the performance going in an upward trajectory, that would be great. Thank you very much.
Thank you very much.
And thank you to everyone who's joined us for this conversation.